Got it.
Morning. How are you guys doing?
Hello. You guys hear us?
Yeah.
Cool. Yeah, we got a few more people hopping on. We'll start in a few minutes. But thank you for everyone to come in. I know everyone's hearing a lot about the Dream for All program. It's a really great program. We have Scott from Main Mortgage. He's going to be going over all the details regarding the program. And then he's going to do a little Q&A if you guys have any questions. But we can get started.
All right, sounds good. Well, welcome everyone. I'm sure you guys have heard a lot about the Dream for All program in California already over the past week. A lot of people have been sharing it on social media and in anticipation of it rolling out this week. So I wanted to kind of go over the high level details of the program. I'll go over kind of some of the questions I've received so far over the past week of rolling out this program, and then help answer any questions, and then we'll kind of talk about next steps. So first slide I have here. What is the California Dream for All program? It's basically a shared appreciation program, and it provides a loan to help qualified home buyers with the down payment. When you sell the home buyer will repay the original balance of that loan program plus a share of the appreciation in the home value. And what they do with the repayments is they're going to take those funds and use it to help future homeowners with their down payment when they buy their home. So the reason why they're doing that is they don't want to do a one-time down payment assistance and then have the homeowners keep that amount. They want to figure out a way to create a program that's going to regenerate over time to help first-time homebuyers. So that's why there's a repayment component to it, which is paying down the original down payment plus the appreciation. How is the program funded? So this is actually coming from the state budget in partnership with CalHFA, which is the California Housing Finance Agency. In this initial round, they're providing $300 million to help home buyers get into their home, with the potential to increasing the amount down the line. There's rumors that they might have about 500 million available, but right now they're leveraging 300 million. And so rough numbers wise, we're expected to help about 23 to 2,800 families with this initial and we're expecting this to end out in funding sometime around the end of summer or potentially at the end of or maybe in fall. So there's no specific time frame of when this is going to end, but it's just whenever the funds run out. So it's going to be a first come first served basis. Any questions so far? I want to make sure I make this interactive and not just go through the slides. So if you have a question, feel free to just jump in.
Scott, you said that they're allocating 300 million tentatively at first, but the goal is for the program to be like self-sufficient. So down the line, they may get more funds, is what you're saying?
Exactly.
Okay. Gotcha. Thanks.
Great question.
And then you said about 300 million equates to how many people that can get pre-approved?
Between 23 to 2,800 families. The number could be more, it could be less, depending on how much funding is used up from the budget.
Okay, so only 2,300 people in all of California. Got it.
Yep. Mhm. Okay, so how does the shared appreciation and AMI work? So think about it this way. The program provides a second mortgage on the home. And so you have your first mortgage, which is your normal 30-year fix, and then there's a second mortgage that's called a silent second. That mortgage does not accrue any interest. There's no payment on it. It's just there. So technically you owe it when you sell the house or when you refinance the property. The amount that you pay back in that shared portion depends on AMI. AMI is the area median income. So think of it as not the average, but if you were to have a list of like the average household income from lowest to highest, it's the middle number. And so if you make 80% of that AMI number, your shared appreciation is calculated a certain way. And if it's above that 80% limit, it's calculated a different way. So we'll go through the calculation in a few slides here. The way to find out the AMI number is by going on Fannie Mae's website. There is a tool that you can look up and see the AMI for the area. So I just pulled up a census tract around Daly City. And so in Daly City, you can see here that the area median income is 151,000. If you make 80% or less of that 151,000, which is $120,880, then you'll get your shared appreciation will be calculated a certain way. And if it's above 120,000, it's calculated a little bit differently. And again, we'll see that in the next couple slides. So 80% is the key number to look at here. If you're above 80%, then you're going to pay 20% of the home's appreciation when you sell or when you refinance. If you're below 80%, that number gets reduced to 15%. One thing to note is the amount of shared appreciation is capped at 2.5 times the original principal amount of that second mortgage. So let's just say you took the shared appreciation program loan of $100,000. So the most that you'll ever pay back is $250,000. Any questions on that so far? Okay, moving on to our first example. So let's just say a borrower purchased a home for $500,000 and they are using $100,000 from the shared appreciation program. And later on, they sell that home for $700,000. So the math on it is the original, they're doing 20% down. So $500,000 purchase price, 20% down, which they get from the program, which is $100,000 here. They will sell the home for $700,000. So there's $200,000 of appreciation. Because they make above 80% of the AMI, they're going to pay 20% of that appreciation, which is $40,000. So when you add the original balance of $100,000 plus $40,000, they would pay back $140,000 back to the program. The second scenario that I have here is where the borrower is making less than 80% of the area median income. So in this example here, a purchase price of $400,000, 20%, so they're borrowing $80,000 for the down payment assistance to purchase the home. They sell the home for $600,000, so the appreciation here is also $200,000. 20% of that is $40,000. However, there's that factor for making below 80% of the area median income. So they only pay 75% of that, which is equivalent to 15%. So they only have to pay $30,000 back to that program. So 30,000 plus the original 80,000, they would pay back 110,000 to CalHFA. Questions on the calculations?
Scott, I have one question. If I invest into my home, say 100 grand of improvements, that 400, say I put another 100 grand, is the appreciation calculated off the 400 or 500?
That's a great question. Because the program just rolled out on Monday, they don't have a specific language or clarification on what types of, if it's original amount plus any improvements that you've done to the home that you can provide receipts for, or if it's what you sell it for. So that's one of the things that we're waiting for clarification on. They're getting a lot of questions and feedback from the community on questions just like this. And so we're expecting them to roll out an answer on that in the future. Any other questions? Okay, so what is the maximum loan amount for the shared appreciation program? So it's going to be the lesser of 20% of the sales price or the appraisal value, whichever is less. So as of right now, the maximum loan amount that you can get on the first mortgage, though, is $1.089 million. And so because once you hit that number or go higher than that, then it's a jumbo loan. And this program can't be paired with a jumbo loan. So the first mortgage has to be below the $1.089 million. Common question that I'm getting asked right now is, can you borrow less than 20% for the shared appreciation? The answer is yes. You can go 15, 10, whatever number you need or you want to. However, as of right now, even if you do less than 20%, you still have the 20% shared appreciation. That might change in the future when they get more clarification on how to handle that. But as of right now, if you are doing the shared appreciation program, you will share that 20% back to the program, even if it's if you borrow less than 20%. All right, I'll move over to borrower requirements. So you must occupy the property as your primary residence. You either have to be a citizen or national of the United States or a qualified alien permanent resident. You have to meet credit, income, and loan requirements of the first mortgage. So you don't have to qualify for the second mortgage, but you have to still qualify for the first mortgage, meaning you have to have your debt to income ratio below 45%. Debt to income is basically how much debt you have on a monthly basis divided by your gross monthly income. And that number can't be more than 45%. In addition to that, your income must be below the income limit for the county. And we're going to have a chart that's going to show what that looks like. And then you also must be a first-time home buyer, meaning you can't have a property or you can't own a property in the past 3 years. If you had a property 4 years ago and you sold it, then you would qualify based on the definition of this program. Okay, so in addition to, we talked about the AMI income limits, and that determines how much you pay back in the shared appreciation portion. However, for the program, your income must be below these limits here in order to qualify for the program. So if you're in San Mateo County, you must make below $300,000 in order to qualify for the program in general. And then if you're above that 120,000 limit, then it's a 20% share. If it's less than 120,000 that we saw earlier, it's 15% appreciation share. Minimum FICO score is going to be 680 for borrowers with income greater than 80% of the AMI, or 660 for borrowers with less than 80% of the AMI. Again, the purpose of this program is to really help families that are disadvantaged, that don't have the best credit, that don't have that much in savings to really get their foot in the door to purchase a home. And that's the purpose, to help those individuals. And so they're a little bit more loose with the guidelines for those folks. A question that I've been getting asked that's come up a couple times is my spouse partner owned a home before we got married, but I'm not on the title of the loan. Can I still qualify on my own? The answer to that is no. And the reason why is because the CalHFA handbook defines a first-time home buyer as anyone that hasn't owned a home or hasn't resided with someone that that's a spouse or partner in the past 3 years that owns a home. So in that situation, you won't be able to just say, hey, I'm gonna put it under my name and buy the house and get the money. You can't do that. Eligible types of property, basically it's got to be single family home, condo, or a manufactured home. But the key thing to note here is it has to be one unit. You can't buy a duplex, triplex, or multifamily and get the down payment assistance for that. The first mortgage is a 30-year mortgage, just your standard conventional mortgage. The interest rate as of yesterday is 6.375%. And this is the same interest rate that everyone gets across the board, regardless of your score. It doesn't matter if you're 700, 800, 680, it's the same interest rate. As long as you meet the minimum requirements to qualify, it's the same across the board. Repayment of the shared appreciation loan. So any of these events here would trigger repayment. So transfer title, sale of the property, when you pay off the first loan, when you pay off the second mortgage, when you refinance, or if you default. The loan is not assumable, so you can't sell the house and have the next person take over that loan for you. However, the program does have a feature that allows you to refinance one time, as long as you comply with CalHFA's resubordination policy. The reason why this is important is because we're in a higher interest rate environment right now. If we get to a lower interest rate environment, what CalHFA will allow you to do is refinance that first mortgage one time, and they're not going to make the second mortgage due. This is just a summary of the different parameters that we talked about, the debt to income ratios, the education requirement. One thing to note here is if you want to put more, get the program to do 20% and you want to put more down payment, you can put an additional 10% down. So your total down payment would be 30%, but that's the most that the program will allow for. So you can't do a 50, you can't use their 20% and then put another 20 or 30% of your own money for like a 50 or 40 to 50% down payment. The max is 30%.
Is a owner has a question.
Hi, I had somebody ask me, what if they refinance and pay off the primary loan? What happens? I think it just stays as a lien, right, on the property?
If they pay off their first mortgage, that is a great question. So it would stay on as a second mortgage and be silent, but I'm pretty sure there's going to be a further guidance coming out on that, because I don't know if they're just going to allow them to leave a lien on there without making a payment for forever, right? And so maybe by paying off that first mortgage, it might trigger in that case, it will trigger the second to be due. So the only way to find out is once we start seeing, right now we're taking applications and submitting them, but we're not getting the official loan documents yet. But once we get that, we can see any language around that. But that's a great question.
Thank you.
So there's a home buyer education requirement as well. So only one of the occupying first-time home buyer has to, on each transaction, has to take the course. You can take it online or in person through any of the housing counseling agencies. One thing that we've been hearing is that because there's so much demand for the program right now, even folks, there's two parts of the education piece. There's the online courses or in-person courses, and then there's an interview as well. And so what's happening is there's been a demand of individuals. Excuse me, sorry about that.
Welcome to Zuckerberg San Francisco General Hospital and Trauma Center. If you have them,
Let me exit out of this. Okay, so there's two components to it. So there's that online course or in-person course, and then there is a counseling session afterward. Right now, the counseling session we heard is booked out 7 business days because there's been so many folks completing the course, but there's not enough counselors to kind of go through to give folks the certificate. So one thing we were recommending is if you're interested in the program to sign up for the course and then get the counseling done and out of the way. Some other questions that we recently have is what is the max loan amount? I talked about this before. Depending on which county you're in, it's usually going to be 1.08 million on the first loan. What is the max loan amount? That's 20% of the total purchase price. Another question we get is, can you use the Dream for All funds to pay off credit cards and car loans in order to get your debt to income ratios to work out? The answer is no. So you'd have to pay those things off with your own funds. The Dream for All funds can only be used for the down payment and certain closing costs. What happens if the value of the home does not appreciate or loses value? It's still due and payable. But if the property is appreciation is 0 or less, then there's no additional funds due. How many borrowers can be on the loan, and can I have a cosigner? No limit to the number of people on the loan, but everyone that's on the loan needs to occupy the property. The reason I have this on here is one of the questions that came up this week was I had a parent who wanted to help their 18-year-old buy a house. And the parent was asking if the parent can co-sign, and then the 18-year-old would get 20% down to buy the house. The answer is no to that, unless the parent was going to live in the house with their son, but that parent already owned a house, and so that wouldn't work out. So again, there's still not like full guidance on all the different possibilities and scenarios out there because the program just rolled out. But these are all great questions that are coming up, hypothetical scenarios, and our team's here to help navigate and kind of go through those as best as we can. With that, I want to open up the floor and see what other questions you guys might have.
Hey, Scott, wanted to pick your brain on a scenario.
Okay. Yep, let's hear it.
So we're currently working with a first-time home buyer. And under traditional means, he does have his 20% down himself. But with this program launching, he's now debating on whether he can use this for leverage to not only buy his first home, but maybe an investment home. Any restrictions in terms of saying he utilized the full 20% for this initial first home, but now reallocating that initial 20% that he intended to use for that house for a second property? Will a program like this handcuff him from buying that second property?
As of right now, in the handbook, there's no language that prevents them from buying another property using the other funds that they have, as long as the funds that's being allocated for the second mortgage on the shared appreciation program is using for their primary residence. There's no restriction on saying that you can't make another purchase with their other funds.
Got it. Okay. And then a second question, in terms of cap, in terms of down payment, is there one with this program?
The maximum down payment that you can do is a total of 30% down.
Got it. Okay. And if they wanted to pay anything above that after the mortgage is funded, is there any penalties?
There is no penalty. So you're talking about making a principal payment after the loan has been signed and completed. There is not. One thing I would say, this might be like an opportunity or another way to strategize is if there's extra funds that they want to put in afterwards, perhaps what you can do is contact the servicer once it goes into the servicing department and it's already administered. Call them and say, hey, I would like to put an extra $50,000 towards my principal payment, and I would like to get this recast. So they would reduce the principal balance and recast it over another 30 years. This is something that you see in other loans, other conventional loans, but we don't know how this is going to play out, but I would imagine they would allow for that. But we'll see.
Got it. So like the recast isn't necessarily a kind of triggering refinance event. It's
That's not a refinance
understandable.
event. It's a recast where you pay down your principal and then it ends up shortening up your the total years. It ends up reducing your monthly payments.
Okay, got it. Thank you.
I have a question. We're also working with another couple. They're currently single right now, but looking to get married in the next year or two. Will change of status trigger, or, because if they're both on the title, will change of status trigger any repayment, or are there any caveats to that?
No, it won't. So
Okay.
at the time, the qualification is looked at the time that they complete the application and
Okay.
that it's fully underwritten. So so they're looking at the status at that point, and once the loan is completed, it's done at that point, and they know that life changes and things happen. So that's fine.
Okay. Thank you.
Other questions?
When can I rent out the property?
What's that?
Like when I buy the home, when can I rent it out?
Great question. So you're buying this property as your primary residence, so you have to move in within 60 days of closing. There's no specific time frame of how long, as of right now, there's no specific time frame of how long you have to live in the property for, but typically, lenders are giving you this rate because they're expecting to be there for a reasonable amount of time, but they know that life changes, right? Let's say you get a new job and you move to Southern California, and because you got a new job, you just have to be able to explain that to if it ever comes up. Because what they don't want people doing is they don't want people to use this program, buy a property, and then 6 months later put it up on Craigslist to rent out, right? And so again, there's no specific guideline on that. You just have to have a valid reason if they ever came up and it was questioned.
Okay, that's my question. Thank you.
All right, so what I'll do is I'll go over like
Sorry, can I ask one more question? Okay. In the event it goes into a trust deed, does the family need to pay back the 20% before it goes into the trust deed?
So like, let's say you transfer it to like a family trust or something like that.
Yeah, let's just say like my client passed and then, it needs to be transferred over to a trustee. Does the family need to pay that before the sale of the home?
Yeah, so I'm gonna gear side towards the side of yes.
Yes.
The reason in my mind is because that's going to be a change in title. So that person is no longer owner of the property, so that's changing to the other trust or family or whoever it is. And so that would be an event where it would be, okay, this amount's now due.
Got it. Okay. Okay, thank you.
You're welcome. As far as next steps, if you're interested in the program, we have a link that will be sent out where you can create a portal. You can create an account on our website. Once you complete the application, our team will schedule a one-on-one consultation and go over your financials to see if this program is even good for you. because, where some folks, they might do this program because they're like, oh, 20%, it's free money, but remember, you have to pay this back, when you sell the home or when you refinance. But what if you had enough money to just do 5% down payment? That might be a better option if you want to keep the equity. So there's different ways to play it out. So what you can do is we'll help kind of go through your scenario. And if there's a better solution, we'll recommend that and kind of find products and banks that will like offer that solution for you. In addition to that, what we do is we're going to connect with your kinetic agent so that they can start looking at homes that fit that criteria of the price points that you're looking for. They'll help get your offer accepted. And then once we have an accepted offer, we'll take that and submit it to underwriting for full loan approval. At that point, that's when the funds are set aside and reserved. It's not at the time of application. So you have to have a contract, and that's based off. And the funds are based off of when you're in contract, not necessarily when you're pre-approved. After that, you close escrow and get keys to your new home. So thank you again, you guys, for joining. Really appreciate it. Great questions. If you have any other questions, feel free to send me an email. My email is just scott@mainmortgage.com.
Cool. Awesome, Scott. Yeah, we'll send over your link to everyone that participated today. But I just want to reemphasize that there's only 2,300 people that can really use this program. So if you really want to take advantage of this, contact Scott, submit your application, and let's find you guys a home. So thank you, everyone.
Sounds good. Thank you, everyone.
you.
See ya.
Thank you. Bye-bye.
Bye-bye.